Okay, welcome everybody. I'm going to go ahead and get started. Um, so welcome to our Practical Farmers of Iowa Farminar. I am Steve Carlson, and I'm a beginning farmer and program associate with PFI. Our horticulture coordinator, Liz Colby, is out sick and wishing she could be here, so she sends her regrets. Um, a couple of things. I want to go ahead and give a little introduction here about tonight and then about PFI. And if at any time you're experiencing problems with audio or anything like that, you can use the chat box and alert our presenters and myself of that. So tonight we're going to be talking about 2 insurance options for fruit and vegetable farmers. And to do this, we're first going to hear from PFI member Emma Johnson of Buffalo Ridge Orchard about her and her farm. Following Emma, we're going to have Kevin McClure from the Farm Services Agency talk about the Non-Insured Disaster Assistance Program. And he's also going to use Buffalo Ridge Orchard as an example to illustrate their insurance options with NAP. Next up, we'll have Mark Shilts from the USDA Risk Management Agency, and he'll talk about whole farm revenue protection, and he'll also use Buffalo Ridge Orchard to show how this insurance option would work for them. And then Emma might have some questions for Kevin or Mark, and after that we'll open it up for all questions. So first a little bit about PFI and our Farminar series. We hold these every Tuesday night during the fall and winter months at 7 p.m. And after tonight there are really only 2 more for the season. Next week is about pesticide drift, and the following week will be over the Food Safety Modernization Act. And actually, we just added a training session for March 26th at noon. That is for any PFI members who are interested in becoming an outreach leader and advocating for healthy soils and water. Practical Farmers of Iowa is celebrating a 30th birthday this year, having started back in 1985. And so it's a big landmark. PFI is a nonprofit organization made up of farmers and friends of farmers, and we really are a member-led organization. Our farmers come from farms of all sizes and enterprises, and from across the state and beyond. Our mission is strengthening farms and communities through farmer-led investigation and information sharing. We use farmer-led investigation and information sharing to help farmers practice an agriculture that benefits both the land and the people. Our values: welcoming everyone, creativity, collaboration, and community, viable farms now and for future generations, and stewardship and ecology. So if you're not already a PFI member, you should join us. Your membership supports our organization and gives you access to our awesome network of members. You'll also get our newsletters and discounts to our events and the opportunity to participate in research projects and all of our programming. You can find all this information on our website. There's links there. And don't forget to check our event calendar for both PFI and non-PFI events. We're right now in the process of planning our field days for this coming year, this coming season, and that information will be out sometime near the end of April, so keep checking back for that because we have a lot of really great things planned. And finally, like I said in the chat box there, please remember to enter your location into the chat box because we like to collect that information for grant reporting purposes. And if you want to help guide the topics for next season's Farminars and help evaluate our Farminars, then please provide your email address so we can stay in touch. And you can also win some pretty cool PFI merch. So if you have questions throughout this presentation for our presenters or PFI, then please enter them into the chat box there. And we'll try to address those either throughout the presentation or we're going to reserve the final 20 to 30 minutes for just questions, so we'll get to it then. Also, you'll notice on the right side of your screen there is a survey there to indicate how many people are tuning in via your single computer. It gives us an idea of how many people are attending. So now I'm going to go ahead and turn this over to Emma Johnson. So thank you.
Thanks, Steve. Just see here. So our farm is a family operation. My parents, who are I guess on the right side in the picture of this first slide, started our orchard and vegetable farm in 2003, and originally was just corn and soybean production. And then my husband and I joined them in 2012. 2012 was also the year where it was unseasonably warm in February and March, and so the trees bloomed about 6 weeks early. So this essentially meant that a normal frost took out about 99% of our crop. So it was, a good introduction to the farm for Marcus and I, my husband and I, because I think we realized that, maybe we should look into insurance. Currently we have 80 acres, like I said. 55 acres are still in a corn-soybean rotation. 12 acres are our apple orchard. 2 acres we have in pear orchard, which the pears aren't in production yet. We planted those only about 5 years ago, so they're just starting to produce. 2 acres of potato production, and then 3 acres of other vegetable production, and this includes lettuce in the early spring to winter squash in the fall, lots of different types of vegetables. We also have 2 unheated hoop houses that are movable, and we basically use this for early spring production of lettuce and spinach, and then later fall production of root crops, and then again mid-season summer vegetables. We have 1 in tomatoes and 1 in cucumbers in the summer. So currently we sell 100% of our vegetables and apples directly to our markets. So we sell them at farmers markets, we sell produce through our CSA, and then we also sell directly to our wholesale customers. And we do have some on-farm sales. So essentially, we determine the price for our vegetables and apples. In a lot of ways, that has been, I guess, a little bit of our insurance. We're diversified in what we grow, but we're also diversified on how we sell. We have lots of different markets, and we can determine the price. And then, of course, for our corn and soybeans, we sell that at a local elevator, and that's really hooked to the commodity pricing that they're able to give us. But interestingly enough, we're able to get insurance for the corn and soybeans, but we haven't really been able to secure what we thought was viable insurance for the vegetables and apples. So before we look at the 2 types of insurance today, I just wanted to talk a little bit about the example that we gave, both NAP and RMA. So we basically established 2 examples. One example was the established farm, and then the other example would be the growing farm. Our farm is constantly growing, and I think a lot of other producers that we've talked to are often in the same place as us, that they're putting more acres in vegetables or other produce from the previous year. So I thought that would be interesting to look at. We looked at basically producing 4 crops. We grow many crops, but we thought just for the sake of a quick kind of looking at what these 2 different types of insurance can offer, we looked at what it would cost to insure 4 specific crops. And those were head lettuce, potatoes, tomatoes, and apples. And again, so one would be we're established, we're growing, and we're not going to grow more acreage of any of those. And then the second example was that over 5 years, we're slowly growing the acreage of all of those crops. So I guess, is Kevin the next person to?
Yep, that's right. I'm going to go ahead and pull up Kevin's PowerPoint and let him take it away.
Well, thanks, Steve and Emma. Basically, what my goal tonight is to kind of give a brief overview of the NAP program, and then, like Emma said, what we did was took about 3 of Emma's crops and just tried to show what NAP availability would be for them, and kind of give just a quick example. So As we said, NAP is a Non-Insured Disaster Assistance Program, and basically what that is it's to reduce financial losses that occur to natural disasters due to a catastrophic loss. And basically, it's like a crop insurance policy, but it's for crops that are not insurable with crop insurance. And so we've got fruits and vegetables throughout Iowa, like aronia berries are really starting to grow here over the last few years, and we've got a number of producers that are starting to insure those as well. What I started down here at the bottom, the crop loss eligibility starts with what's called basic coverage. And basic coverage for a yield-based crop basically means the producer suffers the first 50% of the producer's approved yield, which we call an APH, just like crop insurance, and anything more than that 50%, then the NAP program would kick in. Now the good thing is, with the 2014 Farm Bill, buy-up coverage is now available. NAP's been around since 1996, and we've never really had huge changes to the program. But with the 14 Farm Bill, buy-up has become an option, and I'll talk about that here in just a minute. It's a wonderful option. Basically, NAP's available, just like I said, on crops that are not insurable with crop insurance. Again, as Emma said, corn and soybeans are insurable. Those would be insured through a crop insurance agent. But all of the horticulture vegetables and the apples, and we've got pears and peaches even in Iowa that are looking into the NAP program, those are not insurable with crop insurance and would be available under the NAP program. Eligible causes of loss are just like a crop insurance policy. We're looking at damaging weather, it's natural disasters, drought, hail, excessive moisture, freeze, anything that's considered a natural disaster is what we're looking at to be covered. Again, I look at NAP just very similar to a crop insurance policy. Again, there's going to be some different prices that are going to, I'll show you those in a minute. NAP is a little bit cheaper product, but it also has a little bit less coverage. Again, the 2014 Farm Bill really did help that out. We have also sales closing dates, just like crop insurance. Basically, that's when producers obtain that coverage. I gave two examples there. 2015 aronia berries. Producers needed to be in by November 20th of 2014. That then would cover those winter month type disasters. Grapes in Iowa as well are covered under the NAP program, and those are also 1120 as well. Spring crops are annuals, our horticulture type crops, potatoes, tomatoes. We've got a number of different crops. Those are a 3/15 date that the application has to be completed. Coverage period, it basically starts 30 days after the application signed and approved, and then it ends basically the date of harvest or when the crop is abandoned or destroyed. So just similar to a crop insurance policy where we've got that coverage period through the growing season. Service fees, there is a service fee. It's a non-refundable fee of $250 per crop per county, and there is not to exceeds there of $750 per administrative county, not to exceed a total amount of $1,875. So the easiest way to look at this, if Emma's got, say, 10 crops out there that she would like to insure under the NAP program, basically she would be paying for the first 3, this $250 fee. The rest of the crops would be considered under the NAP program. Now, NAP is crop by crop, so she gets to pick and choose, or producers get to pick and choose, which crops they want to put into the NAP program. Also, this non-refundable fee is paid at the time of the NAP application, and again, prior to the sales closing date. NAP coverage, again, I'm going to talk just a little bit about the basic coverage level. We call this a 50-55 policy. Basically what that is again, it's an APH, actual production history. It's a 4-year minimum with a maximum of 10. and we build that producer's APH. These would be the producer's records, turning in yields to us to build what does that producer actually harvest of that crop on their farm, and build that what I call guarantee. The price is set at 55% of the approved price for the crop. Now that price is set by the state committee, and it's a wholesale price. Now, having said that, the Farm Bill also has put into it direct market pricing and organic pricing. Those are being worked on through the summer months here, and probably will be effective for the 16 year, but we've got some work to do on those. But again, it's kind of exciting. We're seeing changes to the SNAP program that it's going to me, make it much more viable, and products that producers can look at. And I'll talk about the buy-up coverage here. I think it's next. Yep. Basically, the buy-up coverage levels, the basic coverage, again, was 50-55. If a producer wants to go buy-up, then they can go 50 for the yield, 100 for the price, all the way up to what we call a 65-100. Now, that service fee is for the 50-55. That's all that's charged. But if the producer wants to do buy-up, there's a premium that's associated with the buy-up levels. And so I'll give you a quick calculation of that here next. So you go ahead and pay the service fee by crop. Again, there's those $250 not to exceed more than 3 in a county. And then the buy-up has a premium. We basically calculate the guarantee. Here's my example. If Emma decided she wanted to do 65-100 policy for apples, 10 acres of apples, her APH is 415 bushel. That's what she's proved to us. Then we guarantee 65% of that APH at 100% of the set price by the state committee. So our example here shows 269 bushel per acre guaranteed at $13.65. On 10 acres total, that would be a $36,820 guarantee. So the premium calculation is basically 5.25% of that. So in this example, for apples, Emma's premium would be $1,933. Now, there is a cap for this premium because NAP does have a cap payment amount per producer, and that cap payment amount is $125,000. So Congress put in a cap saying if we're only going to be able to pay this amount of $125,000, we're not going to be charging huge premiums. And so the premium cap is $6,563 per producer. So if all the crops add up to more than $6,500, then the cap would be in play, and that would be the maximum premium that would be collected if the producer did buy it. Also, FSA does waive NAP service fees at 100%, and then a reduced amount of 50% for buy-up premiums if the producers meet beginning farmer, limited resource farmers, and socially disadvantaged. Again, I would encourage producers to contact their local FSA office. They can give them the definitions of these and explain exactly what it takes to qualify. NAP coverage does require report of production. The first thing we need is to build that what we call APH, and it's that prior year minimum, again, a maximum of 10, and we need to build that APH. Now, we do get questions, what if you didn't grow the crop, 2 or 3 of that 4 years? Then we also do what's called a T yield or transitional yield, or really what's called a county expected yield for that crop. And we plug those in to build up that guarantee and that APH. Then each year after the policy is taken out, then the producers report production to determine if there's a loss and to build those future APH calculations. Now we also have situations where low yields. Prime example, Emma talked about 2012. We can have replacement yields in years that are extremely low. Just like a crop insurance policy, we're not going to pull in those extremely low yields. There is a replacement for those. Again, the county office can fully explain that to you. Also, a report of acreage is required. There's a final reporting date for each specific crop in order for NAP coverage to be included on that crop. Most crops have a 715 acreage reporting date, and that'd be the time in which the producers would report those acres to the local FSA office. There's where we start building those guarantees as well once we know the number of acres for which the producers report. Then during the growing season, as the producer starts to see if there's losses, then they can come in and file what we call a notice of loss. And here's the requirements, 15 days after the disaster occurs or the disaster becomes apparent by the producer. They'll come in, they'll tell the county office, hey, I had a hailstorm on this day or whatever the disaster condition was. Nothing else needs reported at the time. That's basically just putting us on notice that there was a loss. Then what happens once the producer harvests the crop, then we go into application for payment. If the producer meets the guarantee requirements below that guarantee, then a producer can apply for the actual NAP payment, which would be later on in the fall. This shows you a quick calculation. In our example here, under basic coverage, not buyout, we've got 50% of the APH, the guarantee, subtract out the actual production. If there's a loss, we just take that times the total acres the producer reported to us, times the price set by the state committee at 55%, and that would be the producer's NAP payment. Again, this is the basic coverage level. If the producer does buy-up, remember those prices are set at 100% of the state committee price. There is limitations. We talked about this previously. There's a $125,000 payment limitation per producer or entity. There's also what's called an adjusted gross income provision of $900,000. That basically what we do for the 2015 year, we skip 14 and we average 13, 12, and 11 for this $900,000 AGI provision. That was another thing that Congress did put in for eligibility purposes. This is what I call, it's a nice, I think, picture of what we call the NAP cycle. And basically this would be like a year's worth of how the NAP program for a crop or crops work. First we start out in the winter months developing those prices and those county and T yields, county expected yields and T yields for the crops. Producers come in and make their application by those sales closing dates to get crops insured and coverage to start. During that time, we take in yields and calculate an approved yield, or we call it an APH. Then the producer reports to us once planning's done with spring seeded crops. With apples, it's a little different. Those are usually, I think it's in January is when those are reported. Acres are reported, then we calculate a summary of coverage, just like an insurance policy. So through that growing season then, producers file notices of loss with us telling us what those actual disasters are. And then if there is a loss below that guarantee, then the producer makes application for payment. We make a payment in the fall after harvest once we have that actual production. If the producer did buy up, then we actually don't collect the premium until after, basically after harvest and after the NAP payment has been paid. So similar to a crop insurance policy when premiums are actually collected. So I kind of like this as a nice kind of an overview of what they call the NAP cycle. So with that, what I did was took a quick example from Emma's farm, and I showed here that she's decided to insure 3 crops. And so she's got potatoes, tomatoes, and apples that she has decided. Again, she may have 10 other crops or 15 other crops. She gets to decide which crops she does want to put into the NAP program, and the service fees are collected accordingly. So here we're looking at $250 for the potatoes, the tomatoes, and the apples. She's now maxed out, and so the maximum service fee that would be collected would be $750. Again, each crop does stand on its own for insurance and loss purposes. We don't add them together. They're calculated separately. Here's a quick APH that I built. Again, Emma's turned in yields to us, and so here we have hundredweight, and so 10 through 14 she has showed us and certified this production to us. We divide it out by the number of acres that she had each year, In this case, she had 2 acres for each of the 5 years. And so we take that average per acre and divide it by 5, because she had 5 years worth of history, and we've got a $253 or 253 hundredweight per acre is what the potatoes would have an APH of. There's where Emma's guarantee would start. Here I've calculated the apples, and again this would be a certified production amount that Emma turned in, and again 5 years worth of history she had, and we calculated the 5-year history at being 415 bushel per acre. So for the apples, there's where her the APH would start, and we would start building the guarantees from. So from that, what I did was calculated a quick guarantee for the potatoes. And so in this case, the state committee set a NAP price of $10.83 per hundredweight. Emma's APH for the farm was 253 hundredweight per acre. And so if she did a 50-55 policy, again, which is the basic, at only the $250 fee, then we would be guaranteeing $753 per acre. So if she had a catastrophic loss where everything was wiped out, that would be the guarantee that we would be looking at. So next I calculated apples. And so the state committee set $13.65 for the apple price per acre, per bushel per acre, and it's 415 bushel per acre is the APH that Emma set up. That's what her history was. Again, a 50-55 policy. We're guaranteeing 207 bushels at $7.51. The apple guarantee per acre would be $1,558. Again, it's very important to remember each crop stands on its own when we're building these guarantees and building the policy itself. So what I've done from there is we're assuming that the potatoes were okay and the tomatoes were okay, but Emma actually had a loss on apples. And so here Emma comes in and files a notice of loss on 10 acres, and she says, hey, here's what I harvested, 1,720 bushel, turns in the production on that harvested amount. And so from there, we know that our guarantee was 207 bushel per acre, and she actually had 172 bushel per acre. So we see a loss of 35.5 bushel per acre that we're going to kick into the NAP application for payment. So we take that times the 55% price of $7.51 times the 10 acres that she insured. The payment would be $2,666 for a $250 policy. Now again, this is a 50-55 policy. If you do the buy-up, then it raises that guarantee up dramatically. So you can remember, you can do a 50-100, which would do 100% of the price. In this example, we would, instead of the $7.51, we'd be looking at $13.65 if you did a 50-100. If you did, 55, 60, 65% of the guarantee or of the APH, that just builds up that guarantee even more. And so again, there's a premium associated with that, but that's something that you really need to definitely look into. And I think with that, I think that's what I had, Steve and Emma. I tried to give just kind of a quick overview of how each crop kind of stands on its own, and then a full calculation of what a loss would look like, the basic provisions, or the basic coverage underneath the NAP program. Definitely need to take a look at the buy-up, though, to see what the guarantee and the costs would be. And the counties can calculate that for you.
Yeah, thank you, Kevin. That was really great. If anybody does have questions for Kevin, please go ahead and think about those and type them in the chat box if you want. I'm going to get Mark Shilts, his presentation set up here, and Mark's going to go ahead and take it away. But if you have questions, go ahead and type them in, and we're going to get to a Q&A after a little bit here.
All right. Great. Well, thank you so much, Steve. Um, like Steve indicated, my name is Mark Shilts, and I am with the Risk Management Agency. And what I want to do is just take a little time and walk through the whole farm revenue protection policy. And so this will be kind of just in tandem with what was just given there with NAP coverage for FSA. So basically, before we get started, this is a plan that it's allowing you to insure a variety of crops at once instead of one commodity at a time. What we're trying to do here is give you the option to embrace more crop diversity and in turn kind of help support a wider production of foods. Now this is a plan that's tailored for specialty and organic commodities, both crops and livestock, and also those who directly market their foods to local, regional, or specialty markets. Before I go ahead and get started, I do want to just put this disclaimer up there that of course I will do my very best to be accurate with the policy and procedure. I will say that what I do have up on these slides does not replace it, however. So I don't see that being an issue, but it's just better be safe than sorry. So with that, we'll go ahead and take a look at an overview of what we'll be covering. You can see here that we'll just talk a little bit more about whole farm, what it covers, and how and when loss payments are calculated. And then we'll wrap up like Kevin did with a couple examples there for both a traditional farm that Emma gave us and then one that is growing and expanding. So what does whole farm cover? Well, whole farm basically provides protection against the loss of revenue that you expect to earn for commodities produced on the farm. So this includes both animals and animal products. In other words, what we're trying to do is cover all revenue from all commodities produced in the farm, except for the following things: timber, forest products, and then also animals for sport, show, or pets. So when you think of whole farm, the best way to do it is actually think of what it doesn't cover, and those things are listed right there: timber, forest, and forest products. All other things are covered under whole farm. Unique for whole farm versus AGR Lite, which was a program that was offered in the past in some states, is that we now offer coverage for replant payments. And so this covers the actual cost of replant up to 20% of the expected revenue for that crop. Now, in order to do this, you need to be providing your agent, your company, receipts for that, the cost that goes into that replant. And when you do that, they'll go ahead and calculate out whether that's allowed or not. And of course, based on the policy, it should be, as long as you're able to provide the required documents and supporting documentation. And again, that will be 20% of the expected revenue for the crop. That's a unique feature of whole farm. Now, in order to qualify for whole farm, a couple key elements here. You must file a Schedule F tax form or a substitution Schedule F to the IRS that covers 100% of the farm operation. Now, you need to have these tax returns for 5 consecutive tax years. What this is going to do is it's going to allow you to show your agent and the company your revenue and expense history for that farm operation. And that's ultimately going to be used to determine your insured revenue. You're able to, with whole farm, insure at coverage levels up to 85%, which is quite substantial. Now with this though, you need to have a minimum of 3 commodities that are produced on your farm to do both the 80 and 85% coverage levels. Now to summarize it kind of at this point for the different features of whole farm, what we're again looking at is that all your revenue on that farm is insured together under one policy. And the reason I clarify this is because it's your overall farm revenue that determines losses. So it's not an individual commodity loss kind of, which is more what NAP would be offering. For federal crop insurance, we have what we know as buy-up policies or other traditional revenue protection or yield protection policies. Now with whole farm, you do have the option to purchase these. However, it has to be at the buy-up coverage level, meaning you have to be at the 65, 70% coverage levels. You're not just having catastrophic coverage. An example here would be, say, for Emma's farm where they have corn and soybeans produced. You can have a traditional revenue protection policy on that corn while still insuring it under the whole farm, along with your other crops such as apples and lettuce. Now, how these work and the synergy between the two is that indemnities paid from the revenue protection or yield protection policy, now they're going to count towards your revenue earned under the whole farm policy. That's just a little information on how that would work. Here's a great chart that just kind of outlines the different premium subsidies. You can see here that farms with 2 or more commodities receive a substantial premium subsidy there. Now, you can insure your one crop under whole farm, however, you're not going to get that whole farm subsidy, which you can see is quite substantial and very, very beneficial. There are some, of course, limits on qualification when it comes to whole farm. It's not just simple and cut and dry. There are instances where you may have an approved revenue higher than the maximum listed on this chart. Of course, that'd be a fairly large farm. So whole farm covers up to $8.5 million of revenue, which would be an approved revenue of over $10 million. Also, keep in mind that if you're a producer or a farmer that's working with a lot of animals or animal products, there is a limit on that too. Again, we're looking at 35% of your expected revenue. That's the limit on animal products, and as well as nursery and greenhouse, or up to $1 million. If we're looking at tomatoes and lettuce and corn and soybeans, that shouldn't be an issue. Just a quick overview of where whole farm is available. If you were at all familiar with AGR or AGR Light, which was available in, say, Minnesota or Wisconsin in the past, you can see that this has been expanded to Iowa, which is great, in a lot of the United States, and so it will even be looked at for more expansion here in the near future. All the counties in Iowa are covered under whole farm. So when we look at the amount of insured revenue and how it's determined, we want to just clarify that the insured revenue, what it is, it's the total amount of insurance provided to you by this policy. And it's the lower of your current year's expected revenue, so what you expect to gain in revenue that year at the selected coverage level, or your historic revenue adjusted for the growth at the selected coverage level. And how they're going to get this information is your 5 years of tax information that you provide. One of the key elements of whole farm is diversification. Now, the whole farm diversification is really more of a, how would you say, a commodity count rather than a calculation. So, for example, if you're looking for whole farm and you're producing, say, 95% of your revenues coming from apples and, say, 5% from pears, for whole farm purposes, this would be considered to only be one commodity. However, if the farm had 80% of the revenue coming from apples and, say, 20% coming from pears or lettuce, this farm would be considered to have 2 commodities. So what we're doing here is we're just pointing out that it's not simply going out to your garden and noticing that you've got 5 or 6 or 7 crops. It's that we're encouraging diversity, so we want a substantial amount of every crop produced on that farm. Wonderful. So here we're looking at the commodity count. What does that even mean to you more than just figuring out the calculation? Well, it's not just what's being produced on the farm, like I mentioned. It's that you're producing a significant amount of that. And the reason this is also beneficial and why we're encouraging that is because you're receiving a premium discount for the 2, 3, 4, and up to 7 commodities. Because what you're doing then is you're showing a lower level of risk when you divide that risk among several different crops on your farm. And so that's why you're getting that premium rate discount. Coupled with the premium subsidy, if you have 2 or more crops, it's a pretty good deal. When you're looking at loss payments for whole farm, similar to other multi-peril crop insurance, we're looking at both natural causes of loss and also decline in market price during the insurance year. Now, before any claim can be made, your taxes must be filed for the insurance year. A little bit more about how this works. So, your revenue to count, or your revenue for that year, will be determined using the tax information, or your tax information for that insured year, the farm information as to what was produced, and any inventory information such as what's been harvested or sold or what hasn't been harvested or sold. When this revenue to count, or the revenue that you're gaining, is lower than your insured revenue, which your agent or company will help you calculate, a loss payment will then be made. Now, in order to get this all kind of neat and tidy, you're going to need to provide a few things to your agent. So I'll discuss with you what you kind of need to do there. Again, you're going to need your 5 years of tax information. We've covered that pretty well up to this point. You're also going to need to let them know what kind of tax filer you are. So are you a calendar year filer, an early fiscal filer, or a late fiscal filer? And what this is going to do is it will impact the billing dates and the timeline of when certain reports are due to your agent and when you need to get that information to them. And finally, at the end, you're going to go ahead and let them know about your farm during this meeting with your agent, like what you plan to produce, or if you're organic certified. All this information will go into helping them prepare the required reports. If you're interested in purchasing whole farm, the last day to do so is the county sales closing date. So if we're here in Iowa, we're looking at maybe a March 15th sales closing date. Like I mentioned, at this point, what you're going to do is provide your agent information on what you plan to produce on the farm. They're going to use that information to fill out what they call the intended farm operation report. Now, similar to an acreage report, later that year, you're going to verify what you actually did, what you actually planted. And they'll use, again, your agent will use that information to prepare a revised farm operation report. And the key here is that your due dates for this information to be provided to your agent is all based on when you file your taxes again. So if you're calendar or fiscal year filer. So when's the bill due for this coverage? Well, again, it's going to be based on when you file your taxes, but it'll be one of two dates. It'll be August 15th or December 1st. Most people are probably going to fall into the August 15th category. Now finally, when you go in, you're paying your bill, you're going to want to show, you showed what you've done on the farm, you know, what's actually been planted, and then now what's happened, so what's been harvested. And at this time, you'll know if there's a loss determination if you have filed your taxes, and then you'll provide that information to your agent, and they'll fill out what they call a final farm operation report. Now there's a little incentive when it comes to this operation report, this final report, and that is that if you don't complete it, the coverage for this program will be limited to 65% for you the following year. So that final operation report is key. Okay, so we know a little bit about whole farm, that again we're looking at tax information. So our examples are going to differ a little bit from Kevin's, but it's based on the same information that Emma provided us for Buffalo Ridge. And when it comes to our cost estimator, which is what we use available on the public website of RMA, just a link right on the front page, we need to pick a county. So I just looked up Buffalo Ridge and where this apple orchard was located, and I chose Lynn County. And so the following slides we've got, I literally just took this out of Excel because a lot of this information is key to what we're going to need for the whole farm calculation. So example 1 is an established farm. You can see here that we've got our lettuce, our potatoes, tomatoes, and apples. We're not so concerned about the APH in this case. We're really looking for, again, that you've brought in your tax records, and we can see we've got 5 consecutive years of tax information here with the gross revenue for those crops. Also important is the individual value of each crop, because say for instance you wanted to go in and calculate your own premium estimate, you'd want to know the approximate value of each of those crops. And so this is an established farm. So we go in, we plug in that tax information that you provided, so the gross revenue, and through that we're able to kind of calculate your approved revenue. And I'll show you that kind of on the next page here. But first I just want to give you the example 2, which will be this following slide. And what this is showing is that it's a growing farm. So I mentioned earlier that with whole farm you can prove that up to 10% that your farm is growing. So not to exceed 10%, but say you go into your agent and you've been producing, you know, your tomatoes and apples on the farm, and you can prove that it's been growing over the last 5 years and to what percent it's been growing. You can then carry that percent into the next year. And so this is an example where that is happening. the next slides are kind of where the rubber meets the road. So producer premium. This is all based on the RMA cost estimator, which again is available just on our public website, the very front page. You're going to go in, you're going to provide the revenue that you have gained over the past 5 years from your tax records and the value of each crop. And the coverage levels here you can see are listed. So with all that information that Emma provided, say $290,000 of approved revenue, your premium at 75% coverage level will be $5,831. That's based on about $290,000 of approved revenue. When you look at example 2 and you've adjusted for growth, of course, you are going to see an increase in your approved revenue. Therefore, you will see an increase in your premium. So you can see in example 2 that we're looking at a $6,100 premium for, this is producer premium now for the 75% coverage level. How this all comes into play is that, again, here's a great picture of really where the rubber meets the road and how this will work for each producer. So you've got your $296,000 approved revenue that you came in and were approved at. You've got a 75% coverage level that you've selected, or that was based on kind of the prior slide. So your insured revenue total is $222,000. Again, this is using the data that Emma provided. Well, at the end of the year, you find out that you have a loss, and so based on, a major loss on your apples caused you to lose money, and so your revenue to account for the insurance year was $184,000. Well, you're short $37,000, so therefore that's going to be your payment. So it's really quite straightforward once you get through all the revised operation reports, the final operation reports. You got your approved revenue times your coverage level gives you your insured revenue. Then what you actually got for the year, and the difference between the two is your loss or indemnity payment. Now, where the benefit of the adjusted for 10%, say, would come in is that, of course, you would have a higher approved revenue. But say, your revenue account would be the same for that year, so your loss payment would be higher. So although the premium would be higher, your loss payment would be higher as well. So just a few resources. I was thinking for those who may be interested, there's always a great tool on our website here where you can look up a crop insurance agent. But also, if you're in this situation where you may be asking yourself, where can I go for more information about how to keep better records or to prepare for something like whole farm? That's the Farm Planning Library, which again is available on the USDA RMA website. And this helps you look up maybe better ways to keep records or tax information, transition planning. All of that is available through that website. Of course, we'll open up for questions, but I just wanted to cover, so kind of recap. So we know what whole farm covers. It's basically everything on the farm except for forest products, timber, animals for sport and pet. We know that you would qualify for whole farm if you have 5 years of tax records and your farm isn't bigger than, say, $8.5 million total. And the different features of whole farm. So we know that you are able to also have a revenue protection policy in tandem with this plan. We also looked at insured revenue and why that's so important. Again, you're using your tax information to calculate that. And so we've also walked through the benefits of diversification, that it's more of a calculation, not just a count, because we're again encouraging a wider production of foods. And then we know the important dates. We've got our sales closing date, and we've got some helpful resources that we wrapped up, and again an example that we gave with Emma's farm and how that would work possibly with an expanding operation. So at this point, I guess that's what I have. Of course, we'll be happy to answer any questions.
Yeah, thank you very much, Mark. That was great. I want to first of all, encourage people to go ahead and type some questions into the chat box if anybody has anything. But I was going to first see if Emma had any questions about what she saw with all of that data for either Mark or Kevin. Emma, do you?
I guess I have a few questions. I guess for Mark, you touched on for the whole farm revenue to consider it a commodity, it needs to sort of be a larger percentage or need to be a significant percentage of your revenue. And I'm realizing now that when I looked at the examples that I gave you, we had some of the crops being maybe only 7% of our total revenue. Is that enough to be considered a commodity, or when you put that through the calculator, was that
Right. And that's the challenge.
like, did we not get that?
Well, actually,
Go
your
ahead.
example was actually a really good example, because in a lot of cases there will be situations where, you know, the lettuce or tomatoes or what have you would only make up 7%. I believe in that calculation that wouldn't have qualified for a full commodity. However, it's still a good example because it still would count towards your calculation. So, but if you say produce 20% of that crop, you would have seen a little lower premium. Right. So you're
Okay,
so
so
you're
is
really
there a certain
qualifying.
percentage that you need?
No, there is not, because it's actually quite a complicated calculation. So that's why that we use the cost estimator to walk through that on a slide is a little bit more challenging.
Okay, so I just thought that was interesting because I think that was the first time I realized,
Right.
you know, we actually grow a lot more crops than just the 5. So it's just interesting, but yeah. Is there a way to lump those, you know, like several smaller crops together so it's one commodity
Yep.
together,
Yep.
or?
Yep, that would definitely be possible under the same category. Like, say, in Iowa, even specifically, there are some like vegetables that you would want to lump under all vegetables or other vegetables. Yep. To make one.
So if I had given you an example, Mark, where I had everything was much more evenly distributed as far as where my revenue sources were, would my premiums go down?
Yes, they would have, because you would have qualified for more commodities, which then would have allowed you to have a greater discount. But your example, though, was still beneficial because, again, we are dealing with a lot of people with maybe 3 or 4 commodities, and 2 of them are the big players, you know, so and the other 2 combined may equal 1 commodity. So I still thought it was kind of a real-life example. And that's what's great about the cost estimator online, is that with that information you provided, Emma, and then any individual producer can go out there. If you know a little bit about your tax history, you can go out and just see how it might work for you. Because if you put in your gross revenue and you know the value of the crop for that year, it'll spit out, you know, premium, it'll tell you liability, all that information. Then you can get an idea.
Okay. And then I guess for Kevin, I was interested in looking at what the payout was for our crops, since we direct market 100% of our apples and vegetables. It seems like maybe NAP wouldn't be a great fit for us now, but it sounds like you had sort of touched on that there might be a way for us to kind of change what the pricing structure might be for next year. Is that still, do you think that would be a possibility for?
Yes, definitely. What we're looking at doing is we have to gather data with those direct market sales, because I think the biggest issue that NAP has had in the past is really twofold. First off, you know, a 50-55 policy, we're only covering 50% of anything more than 50% of the production loss. And at 55% of a state committee price that is supposed to be wholesale pricing. And so now that Congress kicked in this direct market pricing, that's should really up those pricing levels for those direct market type sales, which would be your fresh markets, you know, your farmers markets, those types of things. So that's research that we're doing this summer, and we're trying to make it available. The goal is to have it available for the 2016 crop year. And you'd have that available before you'd ever have to purchase a policy for 16.
I think that would really make maybe NAP a little more attractive for us as a farm. because, yeah, when we're insuring something that basically the price that you're giving us seems like maybe it's not quite worth the effort since we are such a small farm and our margin would be really low on those numbers. But
well, and I think too, Emma, the biggest thing, or part of the thing with NAP as well, is those production records, keeping those pick records and those types of things. We've got to have what's called actual production evidence to be able to file those losses. We can take certified production for to build the APHs, but the year of a loss, it has to be actual production records. So those pick records help with that. A lot of it's just that production record keeping is probably the biggest part of the NAP program.
I'm glad that you brought production records up, because that was going to be my other question for both Kevin and Mark. I know, I guess someone touched on a resource for farm planning, but that's something that we struggle with, is because we do keep pick records. We're getting better at keeping good pick records and better at keeping good sales records. But I feel like it'd be really helpful to know specifically what we need to be keeping, so in the future we could secure insurance.
Yeah, from the NAP program, Emma, we definitely have been doing some training with our counties to actually have like producer meetings to be able to discuss this, because that to me is probably the biggest part of NAP, is getting that record keeping process put together. It's once you get it put together, it makes it simple for the year that you have a loss, because you're already turning that in, to build your APHs, and you're going to turn it in for that loss year. We'll probably replace that year if it's a low yielding year for your APH purposes, but you'd have that process put in place.
Mark, do you have, I guess I'm familiar with how sort of the records that NAP requires. Would whole farm revenue require this similar type of records, which I guess you could correct me if I'm wrong, Kevin, but it requires you to sort of have pick dates for each time the crop is harvested, with maybe reference pick sheets, but I'm not sure if that's the same thing that whole farm revenue might require.
It just, for us, for whole farm, it gets down to, again, the way we look at it is your tax information. What you have provided in your Schedule F tax form is enough to complete the record requirements for whole farm. So obviously those types of pick records are very helpful, and I think it will help you in planning and farm planning and transition planning. But when it comes to that information, you're going to always want to start with your tax records and then go from there. No, in terms of planning dates and stuff like that, that stuff is not necessary when it comes to whole farm. Again, great to have. You can't go wrong over planning. I think the issue probably most people run into is under, not over. So if you can file a schedule, file a Schedule F tax form, you'd be good to go. And that we're getting.
So there's no specific form that you're looking for that would be like consistently kept. Okay. Other than tax forms.
What's really great though is in the whole farm handbook and your agent, they would have kind of a nice little cheat sheet for you to kind of keep along with you as you go, just for your own help. We can all use a little help when we do our prep for taxes. It's kind of the same thing. Like at the beginning of every tax season, I get something in the mail from my tax advisor with this information, like, have you done this, checked for this, looked for this, and that's kind of what whole farm is like. And again, it's all coming back to your Schedule F. So your agent will definitely have probably some nice tools for you.
Okay, Steve, did you want to open it up to other questions, or?
Yeah, sounds good. Actually, I had one that I was thinking about for Kevin. he had mentioned earlier, for the FSA to waive NAP service fees and reduce premiums, do you know how people determine if they're a beginning farmer or a limited resource farmer or socially disadvantaged farmer? Do you know the definition for that, or is there a place we can look to find that out?
Yes, Steve, I'll provide that to you. If I remember correctly, I think beginning farmer is anything less than 10 years. Limited resource farmer, there's a certain website that there's a dollar amount. But I can provide all of that to you. And basically, we don't look for copies of, tax records or anything like that. You do a self-certification at the local county office of those requirements. So I can definitely provide that to you guys, what the definitions specifically are.
Great, thank you. And as far as other questions, it looks like Peter had a question. Actually, Peter's question might have been answered. Peter said, whole farm CSA income is paid in advance, but if I buy produce to replace, how would that cost be recouped? And it looked like Mark in the chat box wrote, for a CSA, whole farm covers commodities purchased for resale during the insurance period. Is there anything else to add to that?
Nope, I think that kind of covers it. I think from what Peter's question is looking at is that, again, how would it be recouped? Well, again, you would record that purchase or resale on your tax information, your expenses and revenue, and that therefore would go towards your whole farm approved revenue and approved expenses. So it would be covered. I think
Okay, great. Yeah, I'm a little surprised at the lack of questions tonight. Maybe our presenters were so thorough. I guess I do have another one, and maybe this would be for Kevin too. Um, does NAP, the Non-Insured Disaster Assistance Program, cover crops like small grains, so like such as rye, or is that not something that NAP would?
No, it does. Basically, any crop that can be grown in Iowa that is not insured through crop insurance is available for NAP. And I'll give you an instance. We've had counties sending us in. Producers are looking at growing hops, rye, even wheat. We've got some counties are eligible for crop insurance policies on wheat, but a number of counties aren't. And so any crop that is not insured with crop insurance, we take a look at basically picking up.
Great, yeah, really good to know.
Well, and I did see where, I did see where Peter had a question with regards to $250 max, or a $250 per crop with a $750 max. Why wouldn't I add more crops? Very good point. You definitely could. I think the thing goes back to, it's kind of what Emma was pointing towards, what crops do you have? You can cover all your crops, but are you going to be able to have good production evidence for each one of those crops? Some of the crops maybe are small enough that you don't keep good records for, and so, adding those on in, would you be able to show and prove a loss? I would say that would be the biggest thing. But we do have producers, one in particular, at one time they had about 250 crops on, I think, about 35 to 40 acres that they were looking into putting under the NAP program.
Okay, great. And unless I see somebody start typing in the chat box here with more questions, that might have wrapped things up for us on this St. Patrick's Day evening. So I guess then thank you, Emma, Kevin, and Mark for being so thorough with all your presentations and going through all those examples that are really helpful. We'll be glad to have this in our archives. So big thank you to all of our presenters and for everybody who joined us tonight for this Farminar.
Thank you.
Thanks, Steve.
Thanks, guys.